Welcome to this strategic market assessment on the Iran-Israel war impact on global oil markets. This video will analyze the 2026 crisis and the resulting macroeconomic fallout, drawing from various global research reports. The Strait of Hormuz, the world's most critical energy artery, is now under siege due to the 2026 conflict. This choke point restricts 20 million barrels of oil per day, representing 20% of global daily shipments. Oil prices are experiencing significant spikes due to the geopolitical risk premium. Brent crude surged past $100 per barrel, hitting a volatile high of $119 as markets instantly priced in risk. Price elasticity ensures prices remain elevated at the $120 floor. The macroeconomic fallout includes significant stagflation risks. A sustained $120 to $130 price point is projected to shave 100 basis points, or 1%, off global GDP growth. We anticipate a projected spike in global inflation to 5.0% and a weak recovery with 2 to 3 years of capital dislocation. Policy interventions like strategic petroleum reserve releases, OPEC Plus boosts, and insurance backstops have had limited effect. Market impact remains muted due to depletion concerns, lack of spare capacity, and operators avoiding conflict zones. India is highly sensitive to energy shocks, with an 85% crude import reliance. For every $10 increase in a barrel of oil, there is a projected 30 basis point rise in CPI and a 15 basis point impact on GDP. Resilience is provided by strong FX reserves and $188 billion in services exports. The future outlook suggests prolonged conflict risks. Low price elasticity means small outages cause massive price hikes. Asymmetric warfare, with hidden drone launches and naval harassment, ensures high insurance premiums will persist. Comparing historical war shocks, the current Hormuz siege, with a 15 million barrels per day shortfall, projects a $120 floor. This follows the 1973 Yom Kippur War, which saw a 300% price surge, and the 1990 Gulf War, with a 141% price spike. The silent shock is the global food crisis. Oil and gas are raw materials for fertilizers and logistics fuel. Energy shocks cause stagflation, posing an acute risk of severe shortages, especially for lower-income countries. Alternatives are limited due to pipeline bottlenecks. While Saudi Arabia and the UAE have bypass routes, their 3 to 4.7 million barrels per day capacity is insufficient to replace the Strait of Hormuz, leaving 85% of Gulf exports stranded. Crisis escalation began mid-June 2025. Israeli airstrikes initiated conflict on June 13th, followed by Iranian missile responses on June 14th, triggering global market panic. Late June saw global equities fall, and the USD index rise by 0.95%. Artificial fixes, such as aggressive futures selling or insurance backstops, often fail because they cannot replace physical security in a kinetic conflict zone. This concludes our analysis on navigating energy volatility in a fragmented world. This video utilized a variety of image sources for visual context, and their links are provided here.